Bank earnings are out. It's the first of the year. So who is coming out on top, and what does that mean for investments? Karina Mitchell explains.
Several big banks kicking off earnings today with a mixed set of results. That as bank stocks are coming off their best quarter since 2021, as fears of recession start to fade away and they recover from the pressures of the U.S. regional banking crisis that hit in the spring of 2023. Key to all of the bank earnings results to watch for is net interest income as well as loan growth. JP Morgan Chase was first out of the gate reporting before the bell, and it was an outperformer. It continues to lead the pack. It recorded record annual profit and delivered very strong guidance. Even though EPS was a slight miss, it came in a little bit light at $3.04 versus $3.32 for the estimate. Much of that tied to its acquisition of First Republic Bank when that regional bank failed last year. Now, its revenue was also a slight beat, but it was the guidance that it delivered that sent the stock up by more than 2.5% in this session. It said for the full year that net interest income would come in at about $90 billion. The estimate was for $86 billion. Just to put that in context, that is $30 billion more than its next biggest competitor, Bank of America. Now, Bank of America disappointed with a miss on earnings and revenue. Earnings came in at 35 cents versus 53 cents was the estimate. Revenue coming in at $21.9 billion versus the estimate of $23.7 billion. And Wells Fargo earnings came in line with expectations at 86 cents. Revenue was a slight beat, coming in at $20.4 billion versus $20.3 billion. But the bank did warn that it had to make provision for higher credit losses in the fourth quarter. And Citi Group underwhelmed in its quarterly results as well. Worst performance in more than a decade. CEO Jane Fraser saying, quote, "The fourth quarter was very disappointing. Revenue came in light at $17 billion versus $18 billion that was estimated." And Citi says it will shrink its headcount for the midterm by about 10%. That's about 20,000 of its workforce. Now, more bank earnings on deck next week in the Tuesday session in the U.S. Morgan Stanley and Goldman Sachs both set to report earnings as well. Karina Mitchell, CGTN, New York.
And as Karina briefly told us a moment ago, Citi Group announced it is going to cut 10% of its workforce over the course of the next couple of years. That is going to translate into 20,000 jobs as Citigroup tries to increase profits. The bank just reported disappointing fourth quarter losses of about $1.8 billion. That is the worst quarter in 15 years. Okay, here to talk about all the numbers with big banks, we're joined by Ted Rossman. Ted's a senior industry analyst at bankrate.com and creditcards.com. Thanks for joining us. I certainly appreciate it. You know, on the surface of this, that's just hideous news coming out of Citicorp. That's a big hit right after the holidays.
Yes, we certainly feel bad for those who are affected. You know, I think that this is part of a years-long transition for Citi, really. They've been in the process of winding down some of their international operations and really kind of streamlining their business. But yeah, definitely tough news.
What can we take away from all of the earnings reports today? I think a lot of people just expect banks are going to be able to make money, to do well.
I think in general, bank earnings were probably better than they appear at first glance. Some of the disappointment had to do with these one-time adjustments. These banks had to kick in billions, actually, to shore up the FDIC insurance fund, dating back to last year's bank failures of Silicon Valley Bank and a few others. So it was those one-time assessments that really changed a lot of the calculus with respect to actual results versus expected. But for the most part, I actually think the operations are quite healthy. I mean, certainly some business lines are doing better than others, and there's never any shortage of things to worry about, right? People could say, well, is there going to be a recession? Is there going to be a hard landing? You know, are there going to be more delinquencies? But overall, I actually thought a key message from banks was that the consumer is still in good shape and really hanging in there despite some of these challenges. And I actually sensed a good bit of optimism for the year ahead.
You know, let's pick up on that, because I think the intangibles, the way people look at maybe their 401k account, and right now it's higher than it has been in some times. But yet they read that 10% of a workforce is going to be laid off within the next couple of years, sort of this yin-yang. How are these indications of the status of the economy, or are they?
There are a lot of contradictions in the economy. 80% of Americans recently told Pew Research that the economy is either in fair or poor condition. On the other hand, we have a lot of positive data points we could look at. This is one of the lowest unemployment rates in 50 years. GDP growth came in at 5% in the most recently reported quarter. I feel like a lot of the economic data is better than the sentiment. I think sentiment's really being dragged down by inflation. The fact that people feel like even if they're working and even if their wages are up, that's just being gobbled up by higher prices. Now, that has started to reverse. The last few months, we have started to see wage growth outpacing inflation. We need to see more of that, but I think this is going to be a central economic theme throughout the whole year. A political theme, too, with the U.S. election coming up. I think this whole push-pull between sentiment and reality is going to be an important one.
Yeah, I think that you're exactly right when you talk about the election, because they've become quite caustic in the United States. And one side can look at the numbers and see something very positive. Another can take something very negative out of it and really play that up. In addition to Citi Group, do you think we're going to see more banks cut jobs? And how is that going to play out?
I think there's always going to be some shuffling of the deck. I mean, Wells Fargo, for instance, last year made a decision to pull back almost all of its mortgage lending. And that was a big shift for a company that had been one of the leaders in that space. But in recent years, non-banks, the fintechs like Rocket Mortgage and others, have really taken more of the mortgage market. Has that asset cap dating back to some past regulatory issues. So that's just one example. But, overall, I do think the banking sector and the economy are in good shape. It kind of reminds me of the tech sector last year. I mean, yes, we heard some layoffs, but we also saw a blockbuster year for the NASDAQ. So, I do think that there is a lot to like about the current state of the economy, but it also reminds me of that saying about how if your neighbor loses their job, it's a recession. If you lose yours, it's a depression. There's an all news is local element to some of this economic news.
Good point. Well, how will the potential rate cuts that people are hoping for in 2024 from the Fed help banks moving forward in this year?
I think it'll certainly be welcome for consumers. For banks, it may actually pressure their net interest margin, although even there, you could sort of argue either way. Banks have kind of lamented the fact that they've been paying more for deposits, although I would say the big banks haven't really budged their rates all that much on deposits. They are taking in a lot of interest income on things like credit cards, where the average rate right now is 20.74%. I mean, in general, declining rates would probably be a net negative for banks, but I'm also not convinced rates are going to move all that much this year. I know the market's hoping for 150 basis points of cuts. Our chief financial analyst, Greg McBride, thinks it might only be 50. So we'll see. I think the market might be getting a little ahead of the Fed here. Okay,
quickly, we don't have a lot of time. Are we in for a soft landing this year?
Signs are pointing in that direction. I mean, it's not a sure thing, but I think optimism is definitely growing, and I think there's a good chance that the Fed could achieve the desired soft landing.
Ted, I certainly hope you are right. Ted Rossman, always a pleasure. Thanks very much for your insight.
Thank you.